Welcome back. Now we're being joined by the management of Kalpataru Projects after their fourth quarter results. Revenues were up 17%, EBITDA was up as well, but margins remained flat from last year. Execution pickup was also seen in the fourth quarter, but the FY25 top line growth of 14% was below the initial guidance of 20%. Amit Uplenchwar, who is the of Kalpataru Projects, is joining us right now. Amit, good morning. Thank you for joining in. You ended FY25 with a top line growth of 14%. Now that if you compare with your initial guidance of around 20%, what led to the miss on the top line front, and do execution worries still persist despite the pickup that you have seen in the fourth quarter?
So first of all, a very good morning to you and all your viewers. We had recalibrated our guidance around the Q3 of last year to between 10 to 15%, because primarily one of our segments, which is the water, across the board for all contractors, there was monies held up because of election, and then after that there was a little slowdown in the sector. But having said that, if you look at all our other divisions, whether it is transmission, whether it is building in factories, whether it is oil and gas, all of them grew, in excess of 20-25%. And except for the water, which was a bit of a miss, which is more of a timing issue, I don't see any structural issues with the segment as such. We have a healthy order book, and hopefully this year they'll get normalized.
Right. Amit, good morning. Vinny joining in the conversation as well. So yes, you're saying that you had revised your guidance. 15% is what you spoke about for FY25. But now FY26, then again, could we come back to 20% if things are coming and becoming better? Also, in terms of order inflows, what is the outlook on there? What is the order momentum shaping up like? Your guided range was around more than 25,000 crores for FY25. Would FY26 be something similar?
So, Vinny, in terms of our order book guidance, I think we met our order book guidance last year of 25,000 crores. And, we are looking at a similar kind of order booking at the rate of around maybe 28,000 crores for this year, given the fact that we are already sitting at a 2.5 years order book. So that keeps us in a comfortable position. Second, so far as your, growth is concerned for revenue, we are quite confident this year. Factoring the slowdown in the water that could persist for a quarter or two, we are still looking at a good 20% growth both on standalone and consolidated basis for the company.
Right. Amit, one more question. Apart from water, when I'm checking your revenue also, railways also seems to be a bit muted for FY25. So while water, you're saying couple of quarters maybe could be muted, what is the issue with railway side, railway revenues?
So any railway revenue was muted, and that was a planned muted revenue because the competitive intensity has gone to, on an average tender, there are 20 to 30 people bidding. And we've said this at the start of last year beginning that we are going to be cautious with railways. We are focusing on finishing our current order book and very cautious on how we take orders. We promised the street that we will look at margin improvement. And if you look at our Q4 numbers last year, we've had a phenomenal Q4 with highest ever revenue, highest ever PBT, and highest ever order book closing. And we are quite, happy with that performance. And going forward, that is exactly what we want to continue further. I mean, today, if you look at our balance sheet, we are the strongest ever. We've got lowest ever debt on our books. We are literally about 1,100 odd crores on a standalone basis for a 18,900 crore thereabouts revenue. One of the lowest in the industry. So for next year, what our focus is, whilst we will grow at 20%, to also increase our margin profile going forward from 4.5% to 5% PBT, which we guided last year, and we achieved that. Next year, we want to cross 5% as our PBT on a standalone basis.
But Amit, since you are very cautious on the railways business, is there any plans of divesting it, considering the competitive intensity that you spoke of, and focus on other business segments that you are doing well in?
So, divestment is not a question. Today, if you look at all the EPC players in the country, there is nobody who, is spread across 75 countries in the world as the presence of a EPC business. So today for us, we may have competitive intensity in India, for water or railways. But, if you look at our geographical expansion, today we are looking at water businesses going international. We've bid for quite a few projects and hopefully we get one or two this year converting into order wins. I don't know which quarter that will be exactly. And we intend to do the same with railways, right? So we have the ability to go overseas with other divisions, which other people may not. So diversification, absolutely not. From a viewpoint of railways, yes, diversifying geographically, but no question of divestment at all.
Right. And since you mentioned you met your order inflow guidance for FY25, what about Saudi? Has there been any execution slowdown there or capex slowdown there considering the fall in oil prices? What is the kind of on-ground tendering or the order activity that you're witnessing from that geography?
So, it's a great question. If you look at the results that Saudi Aramco gave this year, just as a, data point, Saudi Aramco's revenues far exceeded all the other 5 top oil companies put together as an aggregate. So I think they're, even at current oil prices staying, above $50 a barrel, I don't see a slowdown in Saudi. In fact, they've got a huge pipeline of orders that they've planned for the next 24 to 36 months, both in upstream, midstream, and downstream segments. And, we've got a very, very large presence in Saudi now in the ONG space, all the way up from north of Saudi, going down up to the border in Yemen. So we are very well placed in Saudi Arabia. Our teams are now established. We have a huge presence in terms of plant and machinery. And hopefully that will help us in catching a part of that business, which looks very, very robust in the years to come.
And Amit, just the last what I want, you did highlight a bit in terms of debt. Obviously, we've seen that reduction coming in the net debt for the company. I want to know the outlook going forward. What are we expecting in FY26 on terms of debt and net debt reduction?
So I think, Vinny, we will keep our debt in line with our business needs. We've always looked at 2 very, very significant metrics. And we've looked at net working capital days. And last year was one of our best. We've had at that base less than 100 days. And in Q4 was even less than 90. So I think we need to continue that trend of having a net working capital days of less than 100. And we keep our interest costs, under 2% of our revenue, which keeps our debt to equity levels very, very low, which keeps our ratios very low. And given the fact that our order sizes are increasing significantly and going towards EPC in nature rather than from what we were 5 years ago, our ROS is also improving steadily. And that is our focus for the next few years to come as well.
All right, Amit, thank you so much for sparing time joining us today. Wish you good luck for FY26 as well. By the way, choppy moves now in the markets. The Nifty is almost slipped into the red now, but still holding on to that mark of 25,000. Take a short break, a quick